Hi, it's Dak Hartsock, Chief Market Strategist, ACI Wealth Advisors, and Process Portfolios. Thank you for joining me. We're going to do a very quick update, maybe 4 or 5 minutes, on the stock market for September 24th, 2015. Quick update and a little bit of outlook. Before I get into what you're looking at, I just want to kind of frame the conversation a little bit for those that aren't maybe familiar with the way the market typically behaves. Usually you get a pullback where the market drops 3 to 5%, about 2 to 3 times per year. Historically, haven't seen the last couple of years because of the Fed, but historically the market pulls back 10, 12, 14%, maybe a little more, about 1 time per year. So, that's kind of, I think, what we're seeing right now is the market, as the Fed's trying to move away from supporting the market quite as much as it has in the past. We're likely seeing a return to more typical behavior for the stock market without, overt Fed support such as we've had for the last couple of years. So, again, to kind of frame the conversation, let's talk about what drives the stock market, and that's earnings. Earnings growth has slowed the last couple of quarters in some sectors, but it's still mostly stable overall, and there are some sectors that are really doing very well. 70% of our economy is the consumer, and the U.S. consumer-driven sectors of the market are really still seeing good earnings growth, and some are seeing very, very good earnings growth. So corporate America is fine. The broad economy is plugging along. There's no recession on the horizon at this point. It's subject to change, but as of today, there's nothing that indicates a recession is imminent. And so with no recession imminent, by far the highest probability is that this is just a standard correction, might go 12%, might go 14, 15%, we'll know when it's over, but it's very unlikely at this point that this is going to fall into a bear market. So that being said, let's understand that when a corrective phase passes, the market usually begins to move back up at that point. So what I've got here is a chart, and I've included this section of it because this is the last substantial correction that we had that went up more than 10, we're down more than 10%. This is 2011, and as I recall, it peaked around 16 or 18%. And what we see is a lot of, basically what we're seeing today. So it's trying to get up, can't quite do it, gives up and kind of falls down, corrects, and then we bang around here for 6, 7, 8, 9 weeks, whatever it is. People realize the world isn't ending, and we begin to move back up. So now let's fast forward to 2015, and that's really kind of what we're seeing here is trying to move up, kind of gets a new high, just like we did down here, can't sustain it, and precipitously falls. And now it's beginning to kind of bang around in this zone. And if you watch some of the earlier market outlooks, you'll know that my thinking at this point is that this correction should be, kind of right around in this zone. This, on the S&P proxy, SPY, it's going to be around 187, 188. Might go a little bit lower. What we're seeing here is this is actually a glitch from August 24th, where the trading exchanges like the NYSE, so on and so forth, had a glitch where buyers were not able to get their orders in during the first few minutes of the market. So it sold down a lot more than would be reasonable. There are some sectors that actually were down 40%, which was a tremendous buy opportunity. And as soon as they finish the glitch, or fix the glitch within a few minutes, the market normalizes and we're back into the predictive zone, where we probably ought to be in terms of a normal correction. So that's mostly what this is, what we're seeing. And, there's a chance, my view is that there's probably a pretty good chance we're going to come back down to this point again, this 187.40, 187.50 area. Thanks to the glitch with this going down here, there's a possibility it's going to come lower and see if that glitch holds. But as long as we don't fall below this green line for any real extended period of time, it's just a normal correction. It's not really worth troubling yourself about if you're an intermediate term investor, long-term investor. And by that I mean your money's in the market for at least 3 years. If your money's in the market and you're going to need it in a year, for God's sake, pull it out. You don't belong in the market when you've got a 1 year or 2 year, maybe even, a 3 year time horizon. So, but for everybody else, this really doesn't represent anything at this point to be too alarmed about. So that's the outlook. I think we're going to see this fix itself in a few days, few weeks, hard to say, probably bang around in this area for a while. And then once everybody figures out the world is not about to end, it's probably going to stabilize and should begin to move up again because our economy is okay. One more point I'd like to give for consideration that reinforces my thesis here that this is just a standard correction is the economy is a lot stronger than it was back here in 2011. And in addition to that, your alternatives right now as an investor is you could buy the 10-year bond and get about a 2.1% yield on it or dividend. And that's great, except interest rates are going to rise. That means you're going to lose money on that bond unless you hold it for 10 years. So at the end of that 10 years, the absolute best you could hope for was to collect that 2.1%. If you take that same money and you buy the market with it, let's just say the S&P, you're going to get right now a 2.2% dividend. So you're actually getting paid more than you would get paid to buy the bond. Plus that, if you fast forward 3 years, 5 years, 10 years, it's very, very likely that in 10 years the market is going to be higher than it is now. There's no guarantees, but it's very likely, based on history. So as an investor, which are you going to buy? You're going to buy the thing that pays you 2.1%, and if you sell it anytime, in the next 10 years, you're likely to lose money on it. Or you're going to buy the thing that pays you 2.2%, and 10 years goes by, it's very likely, or 7 years goes by, or 5 years goes by, it's very likely it's going to be higher than it is today. So you're going to get an excess reward over and above that 2.2%. For a savvy investor, that's a no-brainer. So again, looks like just a corrective phase. Sorry if I've gone on too long. If you have any questions, hit me on the contact page on the website or email me directly, dhartsock@ACI Wealth. Thanks very much.